Before you start, make sure you use Smart Money Index and Dumb Money Index and COT data on weekly chart, and using valuation and seasonality on daily chart and future market assets only. You can execute CFD or FX, but analysis needs to be in future market. COT Report, commercial versus non-commercial versus retail traders. The COT, Commitment of Traders, report provides insight into how different types of market participants are positioned in futures markets. Traders are classified as commercials. These are typically hedgers, like producers or large institutions. They're usually more knowledgeable about the long-term trends in the market. Non-commercials. These are speculators, including hedge funds and institutional investors. They are more likely to take larger, more aggressive positions based on short-term market movements. Retail traders. Individual investors who typically follow the market trends and sometimes trade based on sentiment. How to use it. Interpret positioning. Compare the positions of commercials and non-commercials. For example, if commercials are long and non-commercials are heavily short, this could be a signal that the market is about to reverse, as commercials typically have a better sense of market fundamentals. Contrarian indicator. When non-commercials, the speculators, are excessively long or short, it can indicate an overbought or oversold condition, suggesting a potential market reversal. Retail trader positioning can also be analyzed for contrarian signals. Example: if the COT report shows that commercials are heavily short on gold, while non-commercials are net long, this could signal that gold is about to experience a correction or price reversal. Smart Money versus Dumb Money Index, based on COT report. As mentioned, the Smart Money Index, SMI, is a contrarian indicator that compares the positioning of commercial traders, the smart money, with non-commercial traders, the dumb money. It helps identify potential market turning points based on the assumption that smart money often anticipates trends and positions accordingly. How to use it, smart money. Above 80, when the smart money index is above 80, it suggests that commercial traders, smart money, are heavily positioned in a particular direction, signaling strong confidence in that trend. This is typically interpreted as a bullish signal, as the smart money is often ahead of the retail crowd and is placing its bets based on long-term fundamentals. Smart money below 20. When the smart money index falls below 20, it indicates that smart money is either heavily short or positioned in a way that is contrary to the prevailing market sentiment, suggesting a bearish outlook. In this case, the smart money might be anticipating a downturn or a market reversal. Contrarian view. If dumb money, retail traders or speculators, is on the opposite side of the trade, heavily long when smart money is short, or vice versa, that could indicate that the market is either overbought or oversold and could be ready for a reversal. Example: if the smart money index is above 80 for crude oil, this could indicate that commercial traders are heavily long on oil, which generally signals a continuation of the bullish trend. Conversely, if the smart money index is below 20 for the same asset, it suggests that the smart money is positioning for a potential downturn, which might indicate bearish sentiment and the possibility of a price drop. Incorporating the 80-20 rule into the strategy. Above 80, bullish, strong trend continuation, potentially a signal to go long or stay long. Below 20, bearish, strong trend reversal, potentially a signal to go short or stay out of long positions.
So as a start, we're gonna go to settings and see what we have over here. So this is a valuation. The first symbol is for currencies. The second symbol is for commodities. The third symbol is for stocks and indices. Because the first one, you are gonna compare the currency against a dollar. The second one, you will gonna compare the commodity against gold. The third one, you will gonna compare the index or the stock against interest rate. So you will need to do this every single time you will change your analysis. So For example, if you were analyzing currencies, you will need to change, and then you are gonna change and analyze commodities. You will need to go to settings and change this. Okay, so when you are analyzing currency, you will need to go to this one and select currency. When you are analyzing indices, you will need to go to index and select this. When you are analyzing commodities, you will need to go to commodity and select this one, commodity. When you are analyzing stocks, you will need to go to stocks and then select this one. So it's like it's easy, just you will need to focus in the beginning. So the first one is DXY, the second one is for commodities. The third one is, which is symbol 3, is interest rate. So we will need to focus in this and try to understand these features, so we will not have any problem. And then let's just start. So the valuation, I will need to do it manually, sorry about that. um, okay, so first of all, we're gonna learn, or we're gonna see how to do the valuation in currencies, so in the currency market. First of all, we're gonna select a currency, and then we will compare that currency to a dollar, because the dollar is the reserve currency, the world reserve currency. So we just selected sorry, the euro, and then we will go to the settings and select the currency, because we are comparing the currency against another currency. So select the currency, select the symbol, which is DXY, and then select the first one, symbol 1. So symbol 1 is the currencies, symbol 2 is for the commodities, symbol 3 is for interest rate. So I mean, interest rate means for indices and stocks. So we are here in symbol 1, which means we are in currencies. So we're gonna compare the euro against the dollar. We're gonna see. Okay, so whenever the euro is overvalued against the dollar, we just seen the short move or a down move in the euro. Whenever we have seen the undervalued of euro against the dollar, we have seen a rally move in the euro. And then we're gonna select another currency, which is just an example, the GPY. So over here, we have seen the GPY was overvalued, sorry, against the dollar, and then we have seen then a down move. Again, we have seen the GPY undervalued against the dollar, and then there was a rally in the currency, which is the GPY. Another example, so the third one. Over here, we are comparing the GBP against the dollar. So we have been in an overvalued, and then we have seen a down move. Over here, we have been in an overvalued, and we have seen a down move. It's not a timing tool, but it really helps to know whether the asset is under or overvalued. We have been in an undervalued, and then we have seen the GPY went up. And then now let's just do another example in indices. So we are comparing indices against interest rate. So to compare indices against interest rate, you will need to go to settings and then select index, and then go to the over here and select symbol 3, which is the interest rate. So the symbol 3 is for index and stocks. So we're gonna select symbol 3, and then let's just do it. So over here we are in the Russell. So whenever we have the Russell overvalued against interest rate, we have seen a down move. Whenever we have seen a Russell is undervalued, we have seen a up move. So let's just do another example. We have been in a overvalued, and then there was a down move. Let's just do a Nasdaq. So we are comparing a Nasdaq against interest rate. Let's just see. So we have been in an undervalued environment, and there was a up move. So let's just do another example. We have been in a overvalued, and we have seen a down move. So we have been in an undervalued, and then there was an up move. As I said, it's not a timing tool. And now let's just do commodities. So commodities, we will need to compare them to gold. So how to compare commodities to gold? For example, let's just compare the oil to gold. So first of all, we will need to go to settings, and then select symbol 2, which is gold in yellow, and then go to inputs, select commodity. So we will need to compare commodity, not currency, not index, not stocks. So we are here in commodities. And then, so we are totally fine, and then we can start the valuation right now. So whenever we was undervalued against gold, we have seen a rally in the oil again. Undervalued against oil and against gold, sorry, we have seen up move. Overvalued a down move, which wasn't like that good, but it's fine. As I said, it's not a perfect tool. It's just a valuation. It gives you a value of an asset against another asset. Another example. So we was here over here overvalued, and we have seen a down move. Another example, we have been in a undervalued, and we have seen a up move again. Undervalued up move. And then let's just go to the last one, which is the stock market. So how to do it in a stock market? We will need to go to the stock, and then we will need to go to settings, select stock, and then go to style, select the symbol 3, which is the interest rate, as I said. So whenever we have been in a undervalued, the stock was going up. Undervalued, the stock was going up. Overvalued, stock was going down. So it's like easy as that. So not complicated. You just need to focus on what you're.
Seasonality patterns. Seasonality refers to the tendency for certain assets or markets to behave in a particular way at certain times of the year due to historical trends or cyclical events. How to use it. Historical trends. Look at how an asset has performed in specific months, quarters, or seasons in past years. For example, certain commodities may perform better in winter due to weather-related demand spikes, while agricultural commodities may follow harvest cycles. Predictive tool. Use seasonality to anticipate price movements. If you know that a particular commodity has historically risen during a certain month, you can plan your trading strategies accordingly. Example. Gold tends to perform well in the fall months due to traditional end-of-year buying, so traders can anticipate that gold may experience a seasonal rally during this period. Putting it all together. Example of combining the indicators. Let's say you're interested in trading oil. COT report. The COT report shows that commercials are accumulating long positions in oil, while non-commercials are becoming increasingly short. This suggests that oil may be in a longer-term uptrend, and a reversal from a short-term correction might be coming. Smart money, dumb money index. The smart money is long, while dumb money is short, further confirming a potential bullish reversal. Valuation. You compare oil to the gold and see that oil is historically undervalued relative to the index, suggesting there may be room for oil to rise. Seasonality. Based on historical data, you know that oil tends to rise in the winter months due to increased demand for heating. This combination of indicators, COT report, smart money, dumb money, valuation, and seasonality, could give you a strong signal to take a long position in oil, especially if it aligns with your risk management strategies. Rickly undervalued relative to the index,